Hey, my name is James Baker, and this is just a quick snippet from the last AMA call that we did. And we do these calls every Thursday, and you can join for free and ask your questions, and I'll answer them every Thursday. Join the Telegram or the Discord group in the link below, and I will see you there. Thanks for watching the video, and like, subscribe. See you later.
Okay, next. For a U.S. citizen living overseas, could 112,000 or 224,000 married foreign income exemption be applied to avoid paying tax on a Roth conversion? That is a great question. So the foreign earned income exclusion is an exclusion that allows U.S. citizens who are living and working abroad outside of the U.S. and who are either qualify for the physical presence test or the bona fide residence test to be to qualify to file for the exclusion. So it's the foreign EIGN earned income exclusion, and I'm for a Roth conversion. And the question is, when you have a retirement account, it's subject to tax. If you don't have income in a year, you can convert your traditional retirement account to a Roth retirement account. This conversion is subject to tax, and the reason you do it is because maybe you have a low income year, you have some losses. Or maybe you can exclude it from your with the foreign income exclusion, which is what this question asks. And I'm actually probably going to cite someone else's website because I'm sure someone wrote an article about it. The Balance has one. Contribute. No. Yeah, the Online Taxman is good guys in New York. So yeah, he has a cool one. He has a cool article, and I've referenced this before actually. How to do it. If you qualify, you can convert it. Equal less than the surplus. Surplus unused standard deduction. Yeah, so he says, no, it doesn't count as earned income. And I think that's really the question. The issue, and where I have some hesitation, is that the traditional IRA conversions are usually made out of earned income. So it is technically past earned income. And when you're converting it, does the category of income change? And I'm going to do a little bit more research here instead of just referencing someone else's article that he's just saying you can basically convert 24,000 a year if you're married, tax-free because you're just using your standard deduction, which is a great point. But that's not, that doesn't address, can you actually exclude the conversion as earned income? It doesn't sound like it's earned income, but I'm trying to make that argument. What is earned income for the IRS? Let's look at some tax codes here. Perfect. What is considered earned income? A brand new one. To claim the what is considered earned income for the foreign earned income exclusion for the IRS. Great. So let's just check the IRS website again. It's the best way to do it. And I'll as I read this, I'm gonna talk a little bit more. So a traditional IRA is like a regular retirement account. When you have a job, you contribute your $18,000 a year, and this contribution is a deduction from your income tax this year. But when you take the money out of your retirement account when you retire, you pay tax on it. A Roth account, you don't get a deduction for now, but you don't pay taxes on the principal or any of the gains you take out when you retire. So the Roth is amazing because you grow so much more tax-free. And then there's the math, obviously, like if you're paying a lot of taxes, maybe it makes more sense to do a deduction this year if you're paying 36% because you're going to have 36% more tax, 37% more taxes. And if you factor in state taxes, you have 37% plus state taxes more to grow over that time and then deal with the taxes later. So it's a good argument, but in general, once you have it in the traditional, you can convert it to a Roth by paying taxes on it on a year where you have no income. So let's look at this. Maximum earned income exclusion is 112,000. Great. Amounts paid Amounts received. I'm going to say that I don't think you can, but the article by Online Taxman is really good because you can, if you have no income, you can convert some. Just excluding it is going to be a little bit aggressive. Let's actually look at the form 2555. Oh, amazing. Federico, nice to see you, man. Awesome. Thanks for showing up. This is fun. Okay, so I'm not going to spend too much time on this because it doesn't affect most people. I just want to look at the form because they have the different categories of income at the end of the form. And that's how we're going to kind of wrap up this thought here. Okay. All tax, but enter the amount from line 26. Is there, okay, here you go. 2021 foreign earned income, wages, business, partnership, non-cash, lodging meals, allowances, reimbursements, other foreign earned income. It would be a stretch. You can put it on there and the IRS probably wouldn't audit you for it. They could, but it doesn't clearly say it anywhere that we've looked that you can't do it. So if you want to take an aggressive position, yes. Let's exclude your conversion. And I think I can do it in the software. But it's probably not the right answer. And that's as far as I'm going to get on this question. Okay, that's a good question though. Next question. Our business is as agents selling a principal. We're selling Microsoft licenses. According to IFRS, this is revenue. The same accounting approach. The license is Microsoft, the client, the trade is my first person ownership. Okay, so I think I saw this. Number one, possible standard of authority based on revenue need to present year-end statements. Okay, so technical asset was setting a financial system. Okay. So how to calculate how much tax you owe to the IRS, how to protect yourself from the IRS, and what happens if you get an IRS audit. I'm going to answer all of these questions. And I'm just going to, because I think that'll explain it. So in the US, if you have a US trade or business, a corporation, or you live in the US or you're a citizen, then you have to pay tax on your worldwide income. Basically, if you make money doing something, you have to pay tax on it. It doesn't matter what you're doing. If you're buying and selling stuff, if you're brokering stuff, you're getting commissions, as long as you coming out at the end of the day with more money or fair market value equivalents of things, like if you get paid in houses or food or whatever, technically the value of what you receive is the income for the year that you should be paying tax on. To set up financial recording, most of the IRS, whenever they do an audit, they look at the bank statements, they look at the transactions, and they heavily analyze that. Everything that comes in to your account, the IRS considers income. Everything that leaves your account, you have to justify that it's an expense and not a distribution. So the onus is on you to justify your expenses and then explain when money that comes in is not income. That's how the audits work. It's pretty simple. You know, you have to get all your accounts and they look at every transaction. So what I would recommend is that you have a very simplified and clear banking system and good documentation, especially for the funds that leave your account. You don't need to document funds that come into your account as much because the IRS would default call it income. If it's coming into your account and it's not income, document that. So I use QuickBooks, and that's what we recommend for most of our clients. It's the biggest company. It's the easiest. There's other companies that are easier. There's other companies that are cheaper. I just said it was the easiest, but we like QuickBooks. I like the reporting, and I just like it, so I use QuickBooks, and it basically connects to your bank, pulls in the transactions, and you just say what the transaction was. So if you start a business in the U.S. and you are a U.S. taxpayer, it's important to have your proper accounts and use accounts in very clear transactions, and don't commingle. Don't use personal expenses on a business account. That's very bad. And also to track and organize those expenses throughout the year. And if you do get an audit, it's important to respond to the IRS timely and answer all their questions and provide all the documentation you need to substantiate the position that you took on the original tax filings. Now, for all of my clients and people watching who are foreign and not from the U.S., you don't pay U.S. taxes, you have an LLC and nothing else, the question is more of confirming, if the IRS calls, we're more focused on confirming that you do not have a U.S. trade or business. Because once that is proved, it doesn't matter how much money you make because it's not subject to tax. So those are the two levels of that question. It doesn't really matter what you're doing. If you're a taxpayer, the money you make minus your expenses, what you pay tax on, and you file it affirmatively, and the IRS can ask for proof. And that's like the filing for the year. And then if you're not a U.S. person, it's really just confirming that you're not engaging in the U.S. trade or business. So that's kind of that question there.
Hey, what's up? I hope you liked the video. Please don't forget to subscribe, like, and comment. And if you have questions about the stuff, or you didn't get your question answered, or you left wanting more, you can join the Telegram where I'm actually personally most active, or the Discord group linked below. And we do calls every Thursday for free, or obviously you can schedule a call with our team and we can help you that way. So thanks for being here. I hope only the best things happen to you and your business, and keep learning, keep working, and I'll see you on the next video.